Maybe you already know how to calculate your net worth or put together a balance sheet, but there's probably some really key information that's missing from just that simple calculation that could really impact how you view your net worth and how to maximize it over time. And that's what we're going to talk about today, how to put together and to maximize your personal balance sheet. Hi, I'm Rob Bertman, founder of Family Budget Expert, and I help couples and families save more, argue less, and keep the fun through one-on-one consulting, speaking, and workshops, and also through online courses and other free content, just like this video you're watching here. So today we're going to talk about the balance sheet. In my mind, this is really, really important. If you ever want to reach any financial goals, become financially independent, buy a house, save for your kids' college, save for retirement, pay off your debt, you really need to know your net worth. So let's start off by talking about what is net worth, okay? Net worth, pretty simple calculation, and the best example I like to use here is just home equity in your house. If you own a house, you know that it's worth X. Let's just call it $400,000. And then you also know that you have your mortgage. Let's call that $300,000. So yes, you have an asset that is worth $400,000, and you also have a debt that's worth $300,000. Now, your equity in the home would be, let's just say you sold the house, and net of all fees, you got $400,000 for the house. Well, you'd have to take some of that and pay off the $300,000 of debt. And what would you be left with? You'd be left with $100,000. So that is your home equity, or your net worth in your house is $100,000. And so that's how you calculate your net worth. You add up everything you own: bank accounts, checking accounts, investments, home, cars, college savings, retirement plans, anything where it's like a positive for you, right? Any type of savings or investments that's a positive. And then you look at the other side, your debt. So credit cards, mortgage, student loans, home equity lines of credit, personal loans, auto loans, stuff like that. And that would be on the debt side. So now you have everything you own and everything you owe. And so the way to calculate your net worth is, let's just say you liquidated everything you own and you paid off everything you owe. What's left over? Just like in the house example, whatever's left over, that's your net worth. Okay? So that's how you calculate your net worth. Now, a lot of times people put together a balance sheet and they just list out bank account, checking account, college savings, cars, house, whatever the case may be, other investments. And then they just subtract out the debt and they say, okay, well, our net worth is X. And that is helpful to know, but does it really tell you anything? I can tell you that there are 3 different metrics that you need to add to your balance sheet so that it actually informs you of what it actually means. Okay? Step 1 is you need to know when you can access the money. So for example, if you have all your net worth tied up in your house and you don't have any money in the bank, well, some people call that house poor. Because in order to get that money, you have to sell your house or take out a loan against your house in order to access that money. Now, you could have a great net worth in your house, but it doesn't do you any good unless you take those other steps. Another thing I see is people are what I call retirement plan poor. And I know it's kind of an interesting way to frame it, but basically there's a bunch of money tied up in retirement, but guess what? You can't take it out until you're 60 or older, or unless you take out a loan against it, which I would never really recommend doing, except in like the most extreme of circumstances. In fact, I don't really ever recommend doing it. So you can also have a lot of money tied up in your net worth. And let's just say that you've got like $1 million in retirement, right? That would be nice. But you don't have any money in the bank account. Well, it doesn't really matter for today. It doesn't matter until you turn 60. So the way to organize the balance sheet is based upon when you can access the money. A lot of times where people feel financial stress is because they don't have enough what I call liquid net worth, meaning if you take what they have in the bank account, checking account, or maybe like a brokerage account, a non-retirement account, and subtract out what they owe in credit card debt and other personal loans, it's kind of like a really bad negative number. So rather than just looking at the bottom line number of your net worth, like everything you own minus everything you owe, let's categorize it based upon when you can access it. So you take your checking and savings, net versus your credit card debt or consumer debt. Then you take your long-term assets like retirement plans, college savings, and you net that against things like student loans or things that you're going to pay off over a long period of time. Then you net out, obviously, your house against your mortgage. So how much do you have in home equity? Now, when you add up the net worth in all those categories, you're going to see that your net worth adds up to the same that it did with that original calculation. But what you can see is where you're light and the areas that you need to focus on. Do you have enough of a cash cushion, but you need to start working on retirement? Or is it the opposite? Do you have a good amount of retirement, but you need to start building up that liquid net worth? So looking at your net worth in that way will help you determine how to do that. Okay, so that's the first thing. When can you access the money? The second thing is, what is it actually doing for you? So let's just say that you did not add anything else to the balance sheet, and in other words, you didn't save any more money, and you didn't pay off any more debt. What would happen to your balance sheet under those circumstances? So I call that a return on net worth. It's kind of like this business concept called return on equity. It's like, okay, you've got your net worth, but how much of a profit are you actually running off of the equity in there? And what I mean by that, okay, so let's just say that you've got cash and it's paying you 1%. Let's say you've got $20,000 in cash paying you 1%. That's $200 that's returning for you. But you've got $10,000 in credit card debt that's costing you 20%. So that's a minus $2,000. So if you just take the net worth, $20,000 in cash minus $10,000 in credit card debt, that nets out to a positive $10,000 net worth. 20,000 minus 10,000. But the return on net worth is not great because the assets are earning $200, but you're sending $2,000 at the door. So if you didn't save any more money and didn't pay off any more credit card debt, a year from now, you're going to be minus 1,800. Your net worth would have gone from 10,000 at that area down to 8,200 because the debt is costing you a lot more than what you are making on the interest on your bank account. So now we could apply this all the way down. You've got your housing cost, the price of your house going up by about 3 or 4% a year. But then you've got your mortgage expense and how much is your net worth actually growing there based upon what your house is growing by, but what the interest is costing you on the mortgage. So, and then when you add up how much your assets are growing by, projected to grow by, versus how much you're paying in interest, you can see, is our net worth doing anything? You know, if you want to reach financial independence and hit that 4% rule where basically you can pull out 4% of your net worth and still not really affect the total nest egg that you built up over time, well, your assets minus the interest expense on your debt has to be yielding that in order to make that happen. So this is kind of the health of the balance sheet. So if you were to do nothing, you say, how much are our assets projected to go up, and subtract out the interest on the debt that you're paying, and whatever money's left over, that's how much you could like realistically live on without touching the principal balance of your net worth. So that's a sign of health. Okay, so the way that you do that, pretty simple. You know, interest debt, it's pretty easy. You just put the interest rate of the debt, okay? On the assets, I usually recommend a 1 to 2% for the cash holdings. I'll usually put like a 5 to 7% return on any type of brokerage account or retirement account investments. House, 3 to 4%. Now, vehicles are kind of an interesting one because vehicles actually go down in value. So if someone has a $20,000 car, typically it goes down by 10% a year. So that'll be a $2,000 loss on that asset. So once you line all that stuff up, and you can use the template here in this worksheet, you can fill all that out there. So we've covered really 3 things so far. We've covered how to calculate your net worth. We've covered when you can access your net worth and why that's important. We've covered what your return on net worth is going to be. And now the final component is how much is actually flowing towards your balance sheet on a monthly basis or on a yearly basis. So how much are you actually saving from your cash flow, from your income that's going into your retirement account, that's going into your savings account, that's going into your 529 plans, right? And then on the flip side, how much are you putting towards your debt? How much extra are you paying down the principal on your credit cards, on your student loans, on your auto loans, on your house if you're doing that? Because what's important is, you know, your monthly spending may be, you know, $8,000, $10,000, $15,000, maybe it's $5,000, whatever the case may be. But some of that money is actually going towards building your net worth, either by contributing to your savings accounts or to paying down debt. And so a big predictor of where you're going to end up financially is how much money is flowing to your balance sheet in the form of raising your savings and investments or paying down your debt. So when you take a look at building your balance sheet, you can add that in. You can say, oh, we're putting $2,000 a month towards our balance sheet between paying down the credit cards extra, between putting money into automated savings, between our retirement plan contributions. That $2,000 a month means that your net worth, all things being equal, will be $24,000 higher a year from now. So yes, putting together a personal balance sheet is super duper important because we really want to know what your net worth is. But when you add these three metrics, again, to summarize, it is when can you access it? Can you access it free and clear today? Is it down the road, or is it tied up in an asset, right, like a house or a car? We need to know, what is your return on net worth? So if you didn't contribute anything, would your net worth actually grow or not? And then thirdly, how much are you actually putting into your balance sheet by building up your savings and investments or paying down your debt on a monthly basis? And when you add those calculations to your net worth statement, to your personal balance sheet, I guarantee you it's going to be so much more informative than just knowing how much you own versus how much you owe. So if you want help either figuring out how to free up more money in your budget to put towards your balance sheet or to how to optimize your balance sheet, you can always go to familybudgetexpert.com/help, and we can work together in a number of different ways here to help you get the results that you're looking for. Because ultimately, I want you to save more, argue less, and keep the fun. And the best way to do that is to focus on the budget and what to do with that extra money after all is said and done. So I look forward to hearing you. Thanks again for tuning in. We'll see you next time.